All right, perfect. So, welcome to Enhancing the Accountant Bookkeeper Connection series. And hopefully, can you guys see my screen? Oops, where'd it go? Can you guys see my screen now? Okay, perfect. Okay, I am the host, Tanya Hiltz, CPB, founder of Cloud Bookkeeping Services and Tanya's Bookkeepers Bootcamp. I am an Intuit Firm of the Future Canadian finalist for 2018. Last day of voting, as they said. So vote, vote, vote. Anybody that you vote for does actually help. Donations go to kiva.org. So regardless of who you vote for, it's absolutely amazing. Amazing to be able to contribute just simply by voting to up the contributions to kiva.org. So that's great. I as well was a runner-up for 2017. A top 21 influencer in the Canadian bookkeeping world for 2018, voted by my peers for Insightful Accountant as a top 100 ProAdvisor for 2018, HubDoc top 50 cloud accounting firm for 2017, Black Swan alumni mentoring under Ron Baker, a Futurepreneur Canada volunteer mentor, a member of the Intuit Trainer Writer Network, a member of the Intuit All-Star QuickBooks Online community. We are a Platinum ProAdvisor firm. Advanced Certified QBO ProAdvisor and certified on desktop, certified in many apps, HubDoc, WayPay, T-Sheets Pro, etc. Certified professional bookkeeper through IPBC and over 20 years bookkeeping and income tax experience. A little bit about myself personally. Those are my passions are family, unique experiences, and I'm sure that all of you have been on these before, but if not, those are not my sons. Those are actually some of the stars of our favorite TV shows and some of our bands. So my daughter and I like to do these unique experiences together. And then, of course, that's my little fur baby that we were talking about at the very beginning, down in the bottom corner, Rosie, sleeping there. And I am learning ASL, American Sign Language, with my daughter. So we are I guess co-hosting this with KATA Accounting. We've been collaborating with Jonathan and Bob for a number of years. We've got multiple mutual clients. They work in QBO, have great attention to detail and outstanding customer service. So there's a reason why they are my first choice when clients come to me. Without an accountant, there's absolutely a reason why they're my first choice. It just makes the whole customer experience so much better because they really, really work together with you in a way that will most benefit the client. So that's definitely our end goal, and they share that as well. So I certainly can't say enough good things about them. And of course, they're helping to definitely make a better connection between accounting and bookkeeping, as was the reason why they came up with the ideas for these webinars. All right, so take it away, boys. You guys can start sharing your screens and
I got it.
Dig in.
Okay, so screen is it going to share? All right, so everybody should be able to see the title screen of the presentation.
Not yet. No, we can just we can see you.
We have you, Jonathan. Not that that's a bad thing.
It says sharing now, so
there we go. Got it.
You got it? Okay.
Yep.
Excellent. So today we're going to be talking about revenue accounting. First, get a little bit of information about us. Once I can get my mouse, there we are. So I'm lucky enough to be considered a thought leader in accounting and technology. Was a member of the inaugural Intuit Accountants Council. That was a group of accountants and bookkeepers that helped to advise Intuit on their product and where the directions that they were taking it in. I was involved in that in 2015-16 for a 2-year term. I'm also a Platinum ProAdvisor, Intuit All-Star, and I've been nominated. Thank you very much, Tanya, and got to give a shout out to Tamitha. She also nominated for the Inspire Accountant Award. Very, very flattered by that. It is another voting award, so if you don't mind voting, that would be fantastic. I am a known collaborator. I definitely like to work in groups and in teams, and I'd like to see the industry as a whole improve. There have been some times where we get information that is absolutely shocking when it comes to us. We've discussed a lot of those through these webinars, and that actually was the basis for these webinars. Was how do we make things better for everybody involved? I have a lot of experience in private industry, the mortgage industry. I have a lot of experience with rental properties, and then we do a lot of digital type companies, so e-commerce companies that are service based over the internet. Digital and affiliate marketing is really something that we'd like to expand into, but pretty much technology-based companies. I am also a member of the Japanese Canadian Cultural Center. I was brought in for my QuickBooks expertise, help them switch from one system to that, and continuing on the finance committee and on the marketing committee. And very, very happy to say that between two small changes we made, we've saved $70,000 a year for this nonprofit that does great work. I'm also an avid fisherman. I like to play MTG and poker. If you know what MTG is, you'll know what I'm talking about. So, Bob, why don't a bit about you?
Yes, I actually don't know what MTG is, so
we're going to talk about that one.
We'll have to discuss that at some point. So my career has kind of unfolded in four major categories. First, my educational aspect at the University of Waterloo. Then I went into CA firms, as they were known back in those days, rose up the ranks to manager level, left there and worked in a few major public companies with a focus on the planning side, financial and strategic planning, putting models together, that kind of thing. Companies like Shell Canada, Gerber, some oil and gas and insurance companies. And then I hung out my own shingle and did some work independently with insurance companies, Ontario Hydro, a few other companies you might recognize there. I'm proud to report that I was recently announced or appointed a lifetime CPA. So I was really pleased to be granted that honor. I live just outside of the GTA area in Georgetown with my wife and 4 cats, as Tanya and I were just discussing. My current hobbies are woodworking, travel, and trying to unlock some of the mystery of the stock markets, which takes some patience. So, it's an interesting endeavor.
All right. Well, to recap, a big part of the reason that this series of webinars came about was the concept of a period 13. The concept that at the end of the year, when you've done your 12 months worth of bookkeeping, there's a different level of scrutiny that has to be gone through. Things that really make the books be representative of the activity of the company and the position that they're in. These are often used by accountants to create notice to reader statements. They might be reviewed, they might be audited, but most importantly, they're used by lenders and acquirers. And when this goes badly, this is when people get sued. So it's important to have a good set of books to avoid any unpleasantries. So today we're talking about revenue. We're not going to talk too much about deposits or deferred revenue. We've talked about deferred revenue in a different webinar. Deposits, I think everybody knows, should know how to deal with that. Of course, we can talk about that at the end if there's any questions. We're also not going to talk about trust accounting because it's not a revenue. But mainly we're going to talk about, simple versus complex revenue situations and revenue accounting methodologies. So Bob found a great example in Bombardier that we're going to visit, but definitely not going to go through in detail at the end.
Please, you'll see why.
You'll see why, yeah. So just the basic types of revenue, service, sales of products, rentals, interest income, commissions, royalties, franchise fees. There's many different kinds of sources. it's important to recognize that revenue has to be classified correctly. So sales revenue is from an active business, and it's considered active business income and is taxed at a different rate than, say, rental revenue, which is considered investment income. There are some very clear distinctions that have been made in recent budgets about the purity of a corporation for eligibility for the lifetime capital gains exemption. There's different tax treatments. There's all kinds of different reasons, but it's very, very important to make sure that your revenue is in the correct bucket. So it's really straightforward, right? You get paid, you recognize the revenue. Okay, maybe you have a little bit that you collected that has to be deferred till next year, such as a deposit or a licensing agreement that crosses a year end. It's pretty easy, right? Well, often it is. I think in the vast majority of small business cases we encounter it is, but there are situations where it's not. So, Bob, I've been talking for a little while. Would you like to talk about Bombardier?
Sure. This is an example I came across. And Bombardier's 2017 financial report. And the idea of this is not that we're likely to come across often situations like this, but is just to kind of unfold for you some of the complexities and how complicated it really can be. When I looked at Bombardier's annual report, a picture came into my mind of the number of people this company would have to hire to account for their revenues. And so in order to show you the complexity you can get into, I pulled together the notes and explanations in their annual report that they had to disclose. So in the next few slides, we're certainly not going to go through all of these, but Bombardier and other companies, there's a new accounting policy in IFRS 15, which will require changing how some companies recognize revenues. A lot of it relates to contracts, longer term contracts, and such as Bombardier would have. Bombardier is a company which has an aerospace division, so they build airplanes and short range and long range, and they also have a rail. Their two main divisions are rail and aerospace. So both of those will be long-term efforts covering a number of years. So they had a change in revenue in the policy for recognizing revenues. This is the start of their explanation of the change. Now you'll notice, it's interesting to notice that the policy was released in May 2014, but they gave them 4 years to their fiscal year beginning on January 1st, 2018 to implement the policy. And there will be teams of accountants working on these numbers, restating what has already been reported, auditors crawling all over these results. So, and this is just to report the company's revenue. So, Jonathan, I think we can go through the slides fairly quickly.
Next slide. I just wanted to point out one quick thing, because I think there's a lot of accountanese on these notes. The point of this is to show how complicated it can be, not to make you think that you need to know exactly what IFRS 15 is. Right. Just a quick background, IFRS, for people who don't know, International Financial Reporting Standards, IAS, International Accounting Standard, IASB, International Accounting Standards Board. Just wanted to make sure that was, because it gets even prettier. So Bob, we're just going to scroll through these slides pretty
it's not
quickly,
to go
right?
through this, but what we're going to do at the end is revisit some of these comments. I've extracted some of them And after our discussion, you should be able to have a good feeling for some of the what might be called complex words and sentences in these. So now the second point is in their significant accounting policy notes on revenue recognition, that this isn't about the accounting change. This is now about how they actually record their revenue. So it's broken up into long-term contracts on this slide. The next one, I think they go into their two divisions, aerospace, then they have multiple deliverables, they have other revenue, and then the next one, but we're certainly not going to go through these. It's interesting, government assistance and refundable advances. Government assistance is actually a source of revenue for Bombardier, and then special items.
So the most common place we as people who interact with small businesses are going to encounter this concept is probably progress invoicing with contractors or having to use percentage of completion for smaller builders or developers. Bob, did you want to go through this slide and kind of the concept of percentage of completion method of revenue recognition?
Yeah, absolutely. I use an example of a construction company, but a couple of points. Things get more complicated when the company's efforts cover more than one accounting period. So you have to split the numbers between two periods, especially when it's a contract situation. So I use the example of a construction company with a December 31st, 2017 year end, starting with the simple items, simple revenues. So if they sell some materials or they have some small projects which are all wrapped up by year end, you recognize the revenues as the products and the services are delivered. Very straightforward. Secondly, getting a little more complicated is little larger projects. Those are completed. Now, an important point to make here is that we're not only accounting for and booking revenues, but we're booking profit. We're booking the margins on those revenues. So you kind of have to pull the expenses in the project along with the revenues. So even though we focus on revenues and how you recognize them, this is also about recognizing related expenses, your material purchases that go into the project, the labor that goes into it, and other the amortization of tools and equipment. So it's not just about revenues. We kind of accountants focus even more on the profit margin. So I just wanted to have that point come out clearly. So we
Sorry, go on.
Go ahead.
Go on. Oh, okay. So I was going to say another situation where this might occur is let's say your production cycle is a little bit slower or a little bit faster. It's not a 3-year project, but maybe a 3-month project. But maybe you have 6 of those on the go and they're at different stages. Come the end of the period, this still has to be considered. That could happen in software, it could happen in marketing, design, all kinds of different industries.
Or building
Sorry,
airplanes and trains.
Doesn't have to be that big, but yeah, I mean,
That's right.
houses, airplanes, trains, but it could be as small as, creating a software application that's delivered over a few months, or performing a marketing task for which you're paid up front, and then you have to defer that revenue, or you're billing out at stages of completion, or something very common in the startup community is when milestones are hit. That's when you would bill. Just some other, get the juices flowing for everybody.
So for completed projects, we want to recognize all revenues and make sure all related expenses are picked up when we report at the year end. And that is independent of when the cash or the billings occur. We go away from the normal accounting cycle where you're looking at invoices, you're looking at cash received, you look at the project and you record revenues and expenses based on where the project stands. So if the project is completed, there are some questions you want to ask. Have you completed any work you haven't billed yet? So you may need to book the revenue even though it hasn't been formally billed and you don't have an invoice. Have you asked the client, have you billed any work which hasn't been done or completed yet? So that's the other side of the coin. The client may be doing quick billings based on their arrangement with the customer, and you may need to put in journal entries to reverse some of those billings. The idea is you want to capture the essence or the flavor of the project at December 31st. So despite what's gone into the books, you want to record numbers that reflect the true state of the project. So on the cost side, have you incurred any costs which haven't been billed and recorded in your records? You may need to accrue the expenses. And then the other side again, have you set up any payables for project costs where you aren't recognizing the related revenue? So again, you're thinking of the margin or profitability of the project. So you want the expenses to go along and match with the revenues. If you're recognizing a portion of the revenues, you recognize the same portion of the expenses. And we'll see that in the next example that I brought up here.
I think identifying accruals is very important in this case. In a lot of the small businesses, we have very few accruals that we look at. But when it comes to this, it's even more important to make sure those accrued liabilities, those expenses have been recognized in order to satisfy the matching principle, being that the expenses need to be recognized in the same period in which the corresponding revenue is earned. Sorry, I just wanted to emphasize the accrued liabilities there. Sorry about that. Go ahead.
Absolutely. So now we come to our construction company, and it's a much bigger project, and it's going to run for a period of time over the year end. So it's running from June 2017 to August 2018. And in this case, the industry standard is to use the percentage of completion method. You assess the full project revenues, which likely come from a contract, and the company that's doing the building, the construction company, will certainly have a budget for what all the costs to the end of the contract are going to be. So in this case, the contract is going to be, and I'm talking about a cutoff at December 31st. We were assuming a contract of $150,000 and labor of $60,000, materials of $40,000, and other costs of $20,000. So when you take the full revenues and deduct all the full costs, your budget profit margin is $30,000. So we start to look at the numbers at December 31st, and we assess. This is a whole other ball game to determine the percentage of completion. And you can do it in many different ways, and it sometimes gets tricky. Sometimes the construction company, will have an approach or a methodology that it's used in the past. So we attempt to stay consistent. And usually that will involve pulling together a whole bunch of numbers and doing calculations to come up to the conclusion, this contract at this stage is 25% complete. So now we're 25% complete, and the numbers on the books that the company has already recognized are in the first column there. So the amounts that have been billed to the customer is $25,000. So in day-to-day bookkeeping, that's what you've recorded. The labor is $10,000 that you've attributed to the project. Materials are $12,000 and other costs are $2,000. But you're going to account on a percentage of completion basis. So if we go over to the percentage of completion method column, you do calculations independent. So you, we skipped. Yeah.
Sorry, Bob.
So the revenues you're going to recognize are 25% of the full contract, or 37.5 thousand. So that means you have to adjust the books by $12,500. And you do the same thing with expenses. You want expenses to be 25% of your full project budget of $60,000. So you have to bump up your expenses to $15,000. Same with materials. You have to reverse $2,000 of material costs, and you have to add $3,000 of other expenses. So the profit on the books after you've done all your journal entries will be $7.5 thousand, which is 25% of the profitability. So here you can clearly see the idea that it's not just revenue accounting, it's profitability accounting, really, where the expenses are dragged along with the revenues. Anything else on that, Jonathan, that you can think of?
Well, I was just going to say some of the different methods I've seen, especially in smaller contractors. I've seen people use expenses to drive that percentage of completion. So they have a number of expenses, and they know that they're going to incur a certain amount of cost, and they use those costs to create the revenue as well. So it's just driven by different ways. I've also seen it where it's milestones. So it's like, okay, they get billed once the basement is gutted, and they get billed again once everything is framed in and ready to go, and then another when it's finished, and finally the holdback at the end of the process. Sorry, the holdback I'm referring to is that a lot of contractors are required to hold back 10% of the billing until the customer signs off on the completed job on residential renovations. I'm not sure. We don't do a lot of contractors, so that's the one that I'm aware of. But there might be other kinds of regulations for that. Regardless of the drivers and the methodology that's being used, it needs to be understood that the revenue needs to be recognized and the expenses need to be recognized in the period in which they're incurred. That's the most important part of it. There's probably an infinite number of ways of doing it if you looked at all the different companies out there who are required to do it.
Oh, yeah. So
Bob?
the percentage of completion method, as I mentioned, is the standard. That's what we normally use. But there are a few other methods that are more obscure and used less frequently. One of those is the completed contract method. So it's a more conservative treatment, and we only use it if the percentage of completion method for some reason is not applicable. Like if the project, you really just can't assess the percentage of completion, you might use the completed contract method. Or if the project is extremely risky and they've budgeted $100,000 or $50 million for the expenses, but that's a really rough estimate, and it could be double that or triple in some projects. So your estimates are really risky. So you might go to the completed contract method in that case as well. So we're using the same contract with the same budgeted profit margin. In this case, revenues and expenses are only recognized at the project completion when all results are known. So that's why it's called completed contract. You have to wait till all the numbers are in And that would mean August 2018 before you would report this project. So at December 31st, you would report the revenues and expenses both at zero. But you would definitely disclose information about the project in the notes to the financial statements. And you might even give some interim numbers to indicate the status at December 31st. You would probably disclose why you're not using the percentage of completion method. But on the actual income statement, you wouldn't pick up any of the anticipated profit. And the other important note, being conservative accountants, if at any time on any project we determine that the project is expected to result in a loss, that loss should be estimated and reported as soon as you believe there's going to be a loss.
I just wanted to point out that the completed contract method is for very specific circumstances. And generally speaking, the percentage of completion will be a lot more common than the completed contract method.
Yes, right. And I can see, like in an audit context, I can see you sitting down with the controller or vice president of finance of the company with a list of projects and going over the costs of each of them. You probably have a team of 2 or 3 students going over the costs and the revenues, just to kind of give you a picture of what an accountant would be looking at when they go in to do a review or an audit of the numbers. In real life, it gets quite interesting, and it's really a challenging, and you can really get into these things. And sometimes you disagree with the company, and you're looking to question the methodologies they themselves have used. So the other example, another one is cost recovery method. And if this is usually if there's a probability of uncollectible payments, if you know that the customer in this case who's paying the bills has a reputation, or there's concerns about their ability to pay, you would use the cost recovery method. And in this method, you basically, on the expense side, you book the costs as they're incurred, but you only release revenues equal to the costs. So again, you come up with a zero profit margin that's going into your income number. And you don't recognize any profit until, again, the project is fully complete.
Depending on the nature of the, sorry, I was just going to say, depending on the nature of the business, if you see this a lot from your customer, you should probably have a conversation about how they're selecting your customer. Bob, did you have something to add for this?
No, this one's pretty straightforward. I think we can move ahead. Our time's ticking by as well.
That's true.
So the other one, this one was, I think Jonathan recognized it, but when I was doing research for this presentation, there's another one called the deposit method, and it's a conservative treatment. It sounded to me as if it kind of used like Future Shop or a company that's selling appliances. If there's a question about when the transfer of ownership occurs, like if somebody buys a refrigerator and it's on a contract basis, the customer is making multiple payments, when does ownership really transfer? And the idea of this is you don't recognize the revenues, the billing, the revenue for the sale of the fridge and the profit until the point comes at which the risks and rewards of ownership have been transferred to the purchaser. I don't want to say a lot about this. You could probably write a book about how you would go about doing this. It's not very widely used. But Jonathan, you may have some
Yeah,
examples from current life.
well, I was just going to say, swinging back to the technology realm, something like a Kickstarter or an Indiegogo, where your client is receiving funds up front and they haven't manufactured the product. That would be a very good example when this would be appropriate. All right. We're getting there. We're almost at the end, everybody. So, Bob, did you want to go into this one? Because I'm going to go off on a tangent at the end of the slide.
Okay. So this is completion of production. And again, one that I haven't had a lot of experience with mining and agricultural companies, but I don't consider this to be a conservative treatment. So it has to be used for companies with products which have reasonably assured prices. Prices aren't volatile. The units are interchangeable, so a bushel of grain anywhere is a bushel of grain, and the company has.
Bob just kind of disappeared there. Tanya, can you still hear me okay? Oh, Bob, we lost you for a minute. Nobody heard what you said.
Oh, okay. I'll back up.
Yeah.
A bushel of grain is a bushel of grain.
Yeah, okay. I guess that idea was too much for the internet to handle. So this method, surprisingly, permits recognition of revenues even before an actual sale is made. So I see like a mining company pulling copper out of the ground and refining it. So when they've gotten to the point where they refine the copper and it's sitting there, but it hasn't been sold, it's ready to be sold, they can recognize the revenue on it. I'm sure there are other qualifications, and the auditors would be looking at things like, is the inventory excessive? Do they turn over their inventory very quickly? But yeah, the revenues are recognized even before a formal sale.
So I just like to go off on a tangent for a minute about this subject. There is, I believe it's IFRS or IAS 5, which states that biological product has to be recognized. So it's not, in some instances, it's not even, the product doesn't even have to be completed. It just has to be begun. So for instance, a livestock or a tree farm, or let's get really topical, the cannabis industry. You get a really interesting thing in the cannabis industry happening, especially right now, with companies that are reporting in IFRS, because they have to report as revenue everything that is in the ground, and there's no readily available market data. So you end up with these companies with gross margins that are over 100%, which makes no sense to most accountants and most people in general, and they're recognizing for product that might just be planted yesterday. And of course, they're not recognizing all the revenue from that product, but they have to recognize some of it, which makes investing in this area very, very interesting. Because when you look at the financial statements of, say, a Canopy or an Aurora, you really have to dig into those notes to understand what they're recognizing as revenue and why. This might be something that people will encounter more commonly with farms, any kind of fishing, farming, something like that, where there's a biological product. But again, there are different standards. There's ASPE, which is the accounting standards for private enterprise in Canada, and there's IFRS, the International Financial Reporting Standards. All public companies in Canada have to use IFRS. So that means if any of your companies are public or considering about going public, you have to make sure that you're accounting for the revenue appropriately. I just wanted to go off on that tangent because it was really topical.
And you're interested in the cannabis industry, not for usage, but because it's a growing industry, it's new and kind of exciting.
Some great puns there.
Yeah.
But it is, I mean, this is an industry. If you haven't spoken with somebody from this industry, there's over 100 licensed producers just in Ontario, over 300 applications in. And that doesn't include any of the secondary markets or secondary applications. I think that hemp eventually will completely surpass cannabis as far as being an economic powerhouse. But because there's a legalization now and we can actually start doing research and start doing things with that as a society, we're going to have some really interesting products coming out of there. So that's it's something that we have to consider. There's opportunity there for us as bookkeepers and accountants.
So to wind up, I apologize, the time is slipping by here.
We just have the gift for gab.
Yeah. I just wanted to go back to Bombardier's, all those words that we saw flying by in the slides, and pull out a few examples of things we've been talking about and how this stuff, while it sounds very complex, once you get into it, it's pretty understandable and maybe not as intimidating as you might think. So on the next slide, I've pulled out some quotes from all that verbiage that we saw earlier, which you should be able to recognize. So they state things, such simple things such as revenue is recognized when or as the customer obtains control of the goods or services. Yeah, we know that. Another quote, service contracts at transportation, one of their divisions, will continue to apply the percentage of completion method. It was interesting when I read the annual report, although they're continuing to apply the percentage of completion method, they do change the way they're applying it, so it does have an effect on their profit reported and their equity. But you can understand they apply the percentage of completion method to their transportation division. This change in customers, and I added the explanation, in customers exercising contract options will result in the deferral of revenue, and we've talked about deferred revenue previously. That will result in a reduction of net income, is expected to reduce equity at the transition date by approximately $635 million. This is a big deal. A public company that is reducing its equity by that amount, it's almost certainly going to have an impact on the share price and people's perception of the company. But you can see it's just because they're changing an accounting policy that results in a deferral of some revenue that they originally would have recognized. Moving on, for the aerospace segments, revenues from the sale of aircraft will continue to be recognized when the aircraft have been delivered. It's kind of a mom and pop statement, but that's part of what they have to disclose. When goods have been delivered to the customer, we recognize the revenue. This one's a little more complex. We will need to account for a significant financing component on orders where the timing of cash receipts and revenue recognition differ substantially. So there, we've been making the point a few times that you don't follow the cash in these cases. Your revenue recognition is disjointed from the cash receipt cycle. You don't report them on the same basis. And so they're be including a financing component on orders where the timing of cash receipts and revenue recognition differ substantially. What that means to me is they previously didn't include a financing component. And what I view that as, when I was kind of thinking through this, if you receive cash up front, but you don't recognize the revenue on it, you should attribute some interest to that cash receipt and include that in your view of the revenues. So that's going to change your whole equation on like going back to our percentage of completion example, it's going to change the total numbers on the project, which is going to reflect back in the percentage of completion calculations that you're doing. So this one was a little trickier, but I think we can see that we can think our way through it. If a contract review, this is another quote, indicates a negative gross margin, the entire expected loss on the contract is recognized in cost of sales in the period in which the negative gross margin is identified. So some of these are just mom and pop statements. They're something that every accountant knows, and some of them you need to think about and dig into. This one is simply a mom and pop. And finally,
I just want to revisit that one. This really identifies the importance of pricing, and that might be an area where all of us as bookkeeping and accounting professionals can add value. If a customer is frequently coming up with a negative gross margin, they need to examine both their pricing and their costing to understand why. And that's, quite beyond the typical bookkeeping cycle, but it's definitely an area where a value can be added. That was all.
Yep. And the final one, and we went over an example of this, the completed contract method. They say when the contract outcome cannot be measured reliably, revenue is recognized only to the extent that the expenses incurred are expected to be recovered. So we went over that example. So once you dig through all that verbiage, a lot of these things begin to make sense, and you've heard it all before. I think for me, that concludes the things I wanted to talk about. There's a lot of, you can say a lot about revenues. You can really get into it deeply. So if there are any questions, we'd be happy to answer them at this point.
I'm just curious, as bookkeeping and accounting professionals, what are the most unusual revenue situations you've encountered? Tanya, you must have encountered a couple, right? Unusual revenue situations. I'm thinking about our friends in Innisfil, perhaps.
They would be the only ones that they have, because they're in the construction industry. There's quite a bit of deferred revenue, and they are not only in the construction industry, but they're also basically the bottom of the barrel. So they have horrible AR issues with regards to that, because the way the construction industry is, for anybody who's working in it at all knows that this job doesn't get paid out until it's, so much percentage completion or whatnot. And then they get their check and they, again, 30, 60 days, whatever. And then they have to pay their subcontractors and their subs pay their subs. And unfortunately, my clients are at the very bottom of the food chain when it comes to this. So, it can get a little interesting with regards to that they could easily have $500,000 that if that did not get, in some cases, I think this past year, we literally just finished them up, and I think there was probably, again, about 100,000 or so that they moved over to deferred revenue, so that way they don't have to pay the taxes on it. If that, yeah.
I'd just like to say that that's not a good reason to move something to deferred revenue, but if it's appropriate, that's what it should be.
It's I bowed to the accountant, and this client was with Jonathan, but didn't leave Jonathan for anything Jonathan did. They just have a friend, and their friend gets to drive brand new trucks all the time. Exactly, their friend knows the guy, and so unfortunately, these people, have hopped accountants. They're on like their fourth or fifth accountant, and I've warned them that their accountant and I've warned them that, the accountants will stop dealing with them if they know that they're accountant jumping. But I deferred to that other accountant because it's him signing the tax returns. So
one of my clients in my early days was a company that actually built computers. And there was a lot of, believe it or not, computers those days were built using a lot of manual labor. So, and at year end, they had a number of their machines which were only partially completed. So there would be an assessment of the percentage of completion, and even though they weren't, well, they were probably built to on a contract. So there would be. I didn't do the review of the revenues and expenses on that. I did some work on inventory valuation, but didn't see the revenue and expense numbers on an individual machine basis. But that one was pretty interesting.
Well, it looks like there aren't any questions. I think we threw a lot of accountanese at people. The one thought I'd like to leave you with is, if there are questions about this and you encounter that situation, work with the accountants that you're working with, work with the bookkeepers that you're working with, make sure the right systems are in place to recognize revenue appropriately. If you're coming up to a significant accounting policy change like Bombardier did in that example, that needs to start being planned out well ahead of time. If you come to somebody on January 31st with the December 31st year end, and you've changed the completion of or changed a revenue policy like that, it might take a very long time and a lot of work to get everything set up for the tax return and for statements and so on. So it's important to recognize that the architecture behind whatever bookkeeping is being used is extremely important in this situation. This is an area where a lot of value can be added. Tanya, did you have anything to say in closing? Bob?
No.
I'm good.
I think you've covered it all.
All right. Well, thanks, everybody.
All right. Well, yeah, thanks so much. And hopefully everybody has a great Halloween. And don't forget to vote today, last day to vote.
Right. Thanks,
Yeah.
Tanya.
All right.
Thanks,
Okay.
everyone.
Thanks, guys. Take care.
Bye.
Bye-bye.